Talk about stock market volatility and just crazy markets. And we've been discussing this for a while now. But just in the week alone, you have these days where the market's up 300-400 points, sheds that, climbs back up another 300-400 points, sheds 300, and then drops another 2. And then you have another up day of 350 points. We're seeing major movement in stocks, and we're getting mixed messages. You have the Dow theory right now. We've been talking about that, often with Chuck Carlson, being bearish right now, in the bearish camp. We have the volatility index, which is a good indicator on the chaos in markets. It was almost nearly double just a couple weeks ago, and now volatility has cooled off, and that volatility index has come down. We're getting a ton of movement up and down in markets, and then mixed messages. One message from the Dow theory, another message from the VIX, the volatility index. And that's what we're going to talk about today. Stock market volatility and the crazy markets we've seen as of late. I'm Andy Gersher, and this is Gains. So as I mentioned in the lead, volatility is off the hook. And so let's bring on Matt Matigian, CEO of Blue World Asset Managers here in Chicago. And then as always, be sure to check out Matt's blog at blueworldam.com. Matt, how you doing?
I'm great. How are you?
Oh, I can't complain. So, when we talked before we even went on today, you and I were just discussing the crazy volatility, the mixed signals we're getting from various indicators. And I think we should just start there. Lots of volatility, mixed signals to the market. What are you seeing right now?
Well, I'm seeing the same thing you are, and I like your phrasing, the volatility is off the hook, because it really, really is. And I think it's a great time to be talking about this. We've discussed the nuts and bolts of volatility. We've discussed the nuts and bolts of the indicators that you can look at in order to try to get a gauge, try to get the wind direction for where the market is going. And I think what we're illustrating here in the last, let's call it 10 days, 12 days, what we're seeing is an excellent example of how we really can't afford to put all our eggs into one indicator, if you will. The VIX in the last couple of months, for example, and the VIX is the second-by-second volatility index. It can swing wildly within a single day, so you're looking for a trend. Dow theory, on the other hand, takes a little longer to react, correct? So if we don't look at just one, but we put 2 or 3 of these things together, we can kind of smooth out the volatility and the turbulence that everybody else is suffering and start to get a sense of the trend when there really isn't an obvious trend to look at. So talking about this today, I think is more in line with, okay, we've talked about the nuts and bolts of this stuff. How do we use it? What is the practical application? I can tell you this is a screwdriver and walk away. But if I don't tell you what it's for and how to use it, it's really just information. It's not actionable intelligence. And I think that's really what we're kind of talking about today is, okay, how do we take these volatility metrics and use them to our advantage to enhance our opportunity for success in trading?
Now, I think there's one important point to make, though, and as we talk about this, no one screwdriver is 100% accurate 100% of the time. And that's why you do some of this.
Right. Yeah. You need more than one tool in the toolbox to attack the problem of successful. And this is whether or not we're talking about trading or investing. And to me, those two things are not a distinction without a difference. Trading I regard as the short-term thing, which could be months to weeks, but more likely, minutes to seconds, whereas investing is a longer-term approach. And we've talked about how every portfolio should have its sections, some which are dedicated to the long term and some which are dedicated to the short term, in efforts to enhance and improve the long-term gains.
And one thing I want to throw in here, and why don't we, as we're talking here, that's a great distinction. I'm glad you brought that up. So we will, and then let's talk about this in the in there being two buckets. One bucket, the degenerate trader, the gains listener, or a lot of us, the, getting in and out of meme stocks and crypto and playing momentum. That's one bucket. And, some of us don't even have a bucket like that. Some of us have that bucket's a little too big. And then you have the other bucket, which is the long term. And, you and I talk and just talking with a lot of the gains guests over time, that's a key distinction, because we all should have the one bucket where it's more conservative, looking for long-term growth and that kind of thing. And then, some of us, and I tend to think a lot of the gains listeners probably do have that other bucket, and they love playing in that bucket too. And that's the degenerate, trading everything day to day and that kind of thing. So that's a good distinction to make, first of all.
Yeah, and I'd like to get your take on this. Back in the day, and we always do this to date ourselves, back in the day, when you and I started doing this, and when I say started, I mean, went long our first stock.
Right.
Back in those days, it used to be that...
Let's just call it the 80s. We'll just call it the 80s.
All right, back then, the S&P or the Dow or the Hughes, the NASDAQ, whatever index you want to follow, would routinely return you anywhere from 4 to 8% a year.
Right.
And everything that you did from that shorter term speculative, and I'll use the term speculative, I know you're fond of degenerate, but when I say speculative, I mean what you mean when you say degenerate. The reason that there is a portion of our resources allocated to that speculative end of the portfolio is to try to enhance the returns that you're getting on that, 4 to 8%. If you can pump that up with some speculative plays where you go bust on a few, but the grand slam that you find every now and then, it pushes you 1.5%, 2% further, and suddenly you're talking about 10% compounding gains.
And one other thing I want to throw in there too is before even adding the froth that you get from the speculative, also using the cover call option tactic that you shared with our audience. That'll give you a couple extra percent too. And then you have the degenerate trades.
Well, and without a doubt, and because the covered call to me is the single most conservative way in investing.
Agreed.
That there is, and I define it as zero risk from the point of view that it necessarily makes any loss a smaller loss and any gain a bigger gain. I'm talking about the shorting of options, the buying of crypto, stuff like that. The truly speculative stuff.
Right.
That you and I enjoy so much. But again, I think it's important to point out, hey, look, you guys, there's just a portion of our resources that are dedicated to this, but we spend so much time talking about it because it's the non-boring part of the portfolio.
Exactly.
It's fun. It's stuff that scratches the itch. Long-term growth dividend-spitting stocks, they're just not that sexy. But the point that I wanted to make was, I think it's important to talk about the fact that when you and I started doing this, and you were looking at 4 to 8% per year with that boring end of the portfolio, and then you go out and try to push that up to 9.5%, 10.5%. It was a lot easier back then than it is now, for the simple reason that in the last decade, the markets have been returning 12, 12.5, 13, 14% per year.
Yeah.
It has really, really accelerated, and the number of products and opportunities that have come to light,
go ahead, I'm sorry.
that we could have never dreamed of back in the day. The opportunities to take advantage of that stuff and to enhance the returns has increased, but now you're trying to push that up over what is already a double-digit return. And from my point of view, it just requires a great deal more effort, a great deal more knowledge in order to try to accomplish that enhancement of return. I've been dying to get your take on whether or not you agree with that.
I do. There are a couple things. Now, I think the environment's different because I think the interest rate environment's a big factor. So much more people are much more pulled to stocks to make any kind of return. And that's happened over the last 10, 20 years almost. And then people have gotten a lot more sophisticated. There's definitely a lot more because there's a lot more players. And oh my gosh, the products that are available now is just unbelievable. I mean, when did they start the VIX? I got to think that's got to be that's been around for a while, but all these other vehicles and ETFs, and you can get exposure to anything now. They weren't there. They just weren't there 20 years ago. And I agree with you. It's a whole different animal.
As a matter of fact, it used to be. I was never ever a huge fan of mutual funds, and that's not for anybody. I mean, for me personally, I was never a big fan of mutual funds because they were actively managed. You could get caught in a tax trap, or even in a year where you had a loss, you could end up with a tax liability. There were just a lot of pitfalls for somebody who wanted to actively manage their own portfolio. In those days, you had to go out of your way to buy into an index fund, which was a fund that simply tracked the index. And the brokerage houses, nobody advertised it. They were off the radar because they weren't really moneymakers. And the brokers back then, and this is an important thing we have to make, a transaction, a bare minimum transaction fees, $25 to $50 back in the day too. And you had to get a lot of this stuff through a broker. And so you're just kind of speaking to that. And I think the brokers, they wanted to, keep you as a client, and because didn't it feel like, first of all, I bought, when I started going long in stocks, I bought individual stocks. And then I thought I would be the degenerate or risky if I was buying more the high growth or the riskier stocks, the non-Dow stocks. So it is just completely different. Oh, it is a totally different world when we consider, and this is something that I love to hearken back to again, and it really was during the internet revolution when all of these things started to become available to the retail street level average Joe like you and me who wanted to invest, right? Suddenly we could afford it. But marketing is just marketing, and I'll never forget the first time I saw the advertisement for an online brokerage that said, all trades up to 1,000 shares, only $10.
Oh, my gosh. You're like, that's a deal.
People jumped all over that, and I'm thinking to myself, okay, I'm an idiot if I don't trade in lots of exactly 1,000 shares.
Right, to maximize your cost.
I mean, just, we've gone from $50 and $60 per transaction trades with the full service broker with discretionary authority who had unlimited ability to churn your accounts, to where we are now that commissions have been eliminated from the standard Class A equity portion of the market. It's just amazing the way this has progressed and the tools that we have available, not just to take advantage of the markets, make money in the markets, but the opportunities we have to be better predictors of how to build our portfolio based on where the market is headed.
That is true. And you have to admit, when you're buying stocks, you're competing in a game with everybody else. Investors have gotten a heck of a lot more savvy compared to 20 years ago as well.
Well, yeah,
without a question.
No other reason. We've said before, sentiment is what drives the market. So when you're trying to decide, do I buy this individual stock? Do I buy this individual industry ETF? Do I buy this overarching S&P 500 ETF? It has become a great deal more of an exercise in trying to determine the sentiment of all these new participants in the market, because that's what's going to drive something up or down. And you want to be on the side of the majority that says, okay, when I analyze this, I think we're going up or I think we're going down, and invest accordingly.
And it's important, too. The mix of decision makers has changed a lot, too. So you have a lot more different types of views voting on the market. I mean, when you're buying and selling, you're voting, for or against the market in a way, where 25 years ago, it was all these brokers, all these money managers, and they were the ones who were making these decisions. Now it's in the hands. You get the guy who's, working down the street at the restaurant, making trades during his smoke break. You have a guy who's a money manager, working downtown here, moving millions and millions of dollars. So the other thing is just the mix of people and their mindset has changed, and that's another factor.
Well, and if I may, this is not intended to sound disparaging in any way, shape, or form against the industry.
Right.
And when I say the industry, I mean the brokerage industry and the institutional level investors out there. But with this last round of meme stock hysteria, do you realize for the first time in history, the retail level trader took the institutional level traders to the woodshed?
Now here's one thing I got to throw in there. That's been the narrative, but and I'm totally with that, and I've talked about that for a while. But I have to throw this wrinkle in there. Somebody I know I trust really well said that it was actually a couple hedge funds using retail traders. And that's just another angle to look at that. But you're right. And they've gotten involved. And you're talking about the Reddits, the meme stocks, the AMC, the GME being GameStop, which we've also, and it's funny you're mentioning them now. We've seen them pick up in just the last couple sessions as well in a real big way. But it's interesting how that has all played out. And yes, nonetheless, the retail, the little guy got involved in Reddit and social media.
Well, and I'm glad you said that, because that's exactly where I was headed with this, is that the retail investor took the institutional level investors to the woodshed by virtue of being leveraged by a very narrow swath of institutional investors.
And they really got taken it. They really did get taken to the woodshed. And it's lucky for them it didn't even get a lot worse, because we could, there's a spiral to the upside where it it was bad, but it could have even gotten a lot worse. And by the way, just a reminder, platforms like Robinhood actually kind of bailed some of those guys out.
Yeah, and what platforms like Robinhood did relative to their responsibilities as market makers, I mean, everybody involved, and like I said, it wasn't intended to be any kind of disparagement on the investment industry, not at all, because while we can sit here and smile and smirk about it, it was very, very dangerous for all of us.
Oh, yeah.
Nobody wins when institutional level investors lose, and certainly not when retail investors en masse like we have now, which, again, is that shifting landscape that you described. Nobody wins if anybody is losing huge.
Because then, shops have to unload positions that they really strategically shouldn't, but they need cash. I mean, it causes a snowball effect. And explain that real quick.
Well, the institutions are no less beholden to the rules of margin that we are. And if you have a $5,000 account and that account is on margin, which would allow you to buy up to $10,000 worth of investments, well, it works the same for an institution. If your account value falls below a certain threshold, you get a margin call. Now, for us, margin calls maybe $300, $400, $500 up to $1,500, $2,500 for margin maintenance. Well, if you're an institutional investor getting caught in a short squeeze and you don't have the cash on hand plus the margin to cover the rocket ride that you're on, you're getting that same margin call that you or I would. But now you have a much bigger problem because you're talking about investors' money, institutional money, investors' money. It really creates a very, very precarious environment for everyone. Is that your question? Was that what you want me to?
Yeah. That just to kind of explain the spillover. One thing, we're going to take a break here real quick, but one thing I wanted to talk about before we headed to the break was this recent pop in the meme stocks that we talked about. They soared last year around March. In fact, I've even heard some article called it March Meme Madness. We saw those meme stocks really take off as of late. Seeing that activity right now, what does that tell you about the market at large?
Well, it tells me, and again, this is the cynical, practical view that is mine. It tells me that the meme stocks went crazy, and then it cooled off, and now it's heating up again, right?
Exactly. I mean,
everybody took a breath, marshaled their resources, built up their dry powder again, and now they're ready to go back at it. I see this as being a very cyclical concept, for as long as the meme stock phenomenon is allowed to exist. Eventually, anytime somebody makes too much money or too little money, makes or loses too much money, eventually there's going to be a regulator somewhere who thinks he has a better idea. But until we get there, I really do. I think this is going to be a pause, take a breath, rebuild the war chest, then go back at it hard. What do you think? I agree, disagree?
I got to tell you, full disclosure, I am a diehard Dow theory guy. And I just see further downside here. I could see the initial pop, and I'm looking at this as an opportunity right now as I'm looking at the market. Put shorts on when I can. And I don't necessarily suggest people do that. It's pretty risky because we've seen a ton of volatility. And then I think that the opportunity, another leg down, then I'm going to really be throwing some dry powder to work. I often would have already, started dipping because that's worked. That's what you do. The last 2-3 years, buy the dip, and then it pushes it up, and then, buy the dip, and it's worked. But I also been in this game long enough where there are times when that doesn't happen, and you buy and it drops, and you buy and it drops, and especially the meme stocks that don't have a lot of earnings and necessarily fundamentals behind them. So I'm actually looking for a little further downside. I could be very wrong here. But we're not really that far off.
Sorry.
Oh, go ahead. I'm sorry.
Yeah, sorry. You and I do that, right? We talk over each other.
Yeah. Well, welcome to the club, but that's what we do. Yeah. So, go ahead.
I was speaking specifically about the slice of the pie that is focused on the meme stocks. The meme stocks are not, and the investors that are trying to play these, massive gains and massive shorts on a day-to-day basis based on the meme, based on Wall Street bets and all that kind of stuff. They're not following the old rules. They're not looking at Dow theory. They're not looking at the VIX. They're looking at the memes, right? They are trying to ride waves and play the troughs.
Oh, their momentum plays are definitely going with momentum.
Right, and they're not following those rules of underlying fundamentals, and it's two completely different ways of analyzing opportunity. You and I are both the same way, and yes, we don't pick one or the other. We got our toes in both.
Yeah. I mean, I don't like the meme stuff unless it's charted out, but that really is a dangerous area. I mean, GameStop, that one still scratches my head.
Well, didn't GameStop at one time have a market cap that exceeded Amazon?
I don't know if it was that high, but I mean, yes. I mean, it's been a really crazy valuation, especially compared to, I mean, it was a struggling video game retailer without a lot. And I can see some other value when they're talking about adding NFT marketplace and a variety of things. So there's potential there, but boy, some of those meme stocks are dangerous. Now, and that comes back to our initial thing. We have the bucket that contains our wealth and long term, and we'll be able to continue to eat and have a nice life. But you have to admit the degenerate meme stuff is fun. Let's go to a break real quick, and then we can continue this discussion on the other side. Hey, real quick, be sure to subscribe, follow. Leave us a 5-star review on Apple Podcasts, if that's an option for you. And as always, subscribe and turn on those notifications so you know when a new Gains episode drops. We drop Gains episodes on Wednesday and Friday mornings. So just make note of that. We just recently changed our schedule just a little bit there. So we drop the Gains podcast on Wednesday and Friday mornings. Okay, we're going to be right back with Matt Matigian talking volatility, stocks, markets, and the likes. We'll be right back.
If you enjoy learning about communities, culture, and history, then Shades of the City podcast is for you. We will bring you stories like the legacy of Johnson Publishing Company, most notably known for Jet and Ebony magazines.
Basically what the world said African American people could not do, these magazines proved otherwise.
Subscribe now to Shades of the City on the Odyssey app, Apple Podcasts, or wherever you get your podcasts.
All right, back with Matt Matigian, CEO of Blue World Asset Managers here in Chicago, of course. And as always, check out Matt's blog at blueworldam.com. Matt, it's plug time, as always. So get your plugs, get your love in there.
Yeah, actually, it's the same thing I always say, which is questions, comments, concerns, anything like that. Never be shy about reaching out. Matigian at blueworldam.com is my email. You can find me on LinkedIn. You can find me through Andy if you want to go that route. But never, ever be shy about reaching out. And a lot of the game's listeners have, and it's led to a lot of really fun conversations. So I really appreciate it, and that's the number one thing. Number two, you remember we did the episode not too long ago on the family investment club concept?
Yeah, you have a meeting tonight, if I'm not mistaken. In fact, we'll have to wrap it up here in just a bit so you can meet that family meeting deadline.
Well, the last episode, the episode where we spoke about the concept of the family investment club, got so much interest that, and this was one of the suggestions actually of one of the game's listeners, said, you guys really need to start a website based on the family investment club and share with us what you're doing and why you're doing it. And, it was one of those slap yourself in the forehead moments like, yeah, why didn't I think of that? So I will say as a plug, and I'll tell you obviously when it actually becomes a reality, but that is a plug that I will put on the fairly near-term horizon.
Oh, very interesting. That's so will you share what your investment club is investing in? What would that include? I'm just curious.
It would follow, and again, this is going to be done with people who are a lot smarter than me on how to put this together, but it would generally follow the flow as I conceive of it now of our meeting agenda. Our standard meeting agenda always starts with if there's a special presentation to be given. For example, tonight, my wife is giving a special presentation on margin accounts and all of the ins and outs of margin, pluses, minuses, the pitfalls, the practical application, all of that. And those, if we have special presentations, they usually last 10 to 15 minutes, a quick overview of a topic. Is it a Zoom?
Is it a Zoom call that you do? I know that, you might not all be together. I was just curious how you handle if somebody's not there, do they still join you remotely?
Absolutely, yeah. It's virtually impossible for us all to ever be in the same place at the same time.
Okay.
So we use the Teams platform, the Microsoft Teams platform. And what I was also encouraged to do when I started floating this idea, to our tech people, was to start recording the meeting.
Oh wow, that would be interesting. Yeah, wow. That's
so
you'd put that the recording of your meeting on that tape as well, or on that site as well, maybe? Is that what you're thinking?
Yeah, exactly. The summary of the meeting following the special presentation, macroeconomic analysis, portfolio position review, and investment presentations would pretty much, the blog portion, the written portion, would summarize all of that stuff per the monthly agenda. But then for those who wanted to actually see and participate in and listen to the actual meeting, could either access the recording of the meeting or actually get a login and be able to come in, listen live, ask questions.
Oh, wow. That's really, really, really detailed. That's pretty interesting. So I'm looking forward to seeing what you do with that. And that's was one of my favorite episodes. I really do love that concept, the Family Investment Club.
Yeah, well, I too am incredibly curious as to how that's going to all work.
Well, and the one last thing about that before we get back to volatility is you look at this as a way to create generational wealth, generation upon generation. Just explain that real quick.
Well, due to the circumstance my wife and I found ourselves in when we were in our mid-20s, we were left frankly, when the patriarch of the family passed away unexpectedly, my wife and I were left with an utter mess, and everybody in the family turned to us and said, hey, bail us out here, figure it out, do what you got to do, don't let us suffer in our lifestyles. and my wife and I knew nothing. I mean, we knew nothing. And we committed to each other that we would never, ever, ever put our children in a position to have to take over a process, a business, wealth holdings without knowing what they were doing. And I've told my kids for years, I can leave you money, I can leave you stocks, bonds, real estate, whatever you want. None of it means a thing if I don't teach you how it was made, how to preserve it, how to grow it. So it's all about the education. It's about perpetuating not the wealth. That's a side effect of perpetuating the knowledge that we've gained, and we just don't want them or any generation of our family, or I don't want any generation of anybody's family to have to acquire the knowledge under the duress that we did.
Yeah, having that, having a financial plan ahead of time. Just speaking of when a family member dies, getting those ducks in a row ahead of time is crucial, because on top of dealing with a financial mess, you're also dealing with the loss of a loved one often too. And, it's just taking that off your plate when you're dealing with the death of a loss or the loss of a loved one just makes the process a little bit easier. Let's switch back over to, we were talking about we're getting mixed signals. I kind of said, I'm kind of a big believer in the Dow theory, and I'm kind of following it right now and trading appropriately as if there is further downside. You, on the other hand, you talked about the VIX, and there's a great point, because the VIX was much, much higher not that long ago. I think just like, maybe 2 weeks ago we saw it at 36.45, and now it's in the 20s. Talk about the VIX. Talk about what you're seeing and how you're assessing kind of the uncertainty in market direction right now.
And I'm glad you phrased it this way, as usual. Like I said at the top, I think it's foolish to put all of your eggs in one metrics basket, right? So if the VIX is low and Dow theory is high, those are two completely different metrics to measure volatility and expected market direction, right? If those two completely different metrics agree and validate each other, I'm pretty confident that whatever the direction says, if that says it's going up, and I'm going to be heavy on the long side.
Right.
If, on the other hand, the VIX is high and Dow theory is trending low, well, again, that's a mixed signal, right? The short-term minute-by-minute metric says, hey, we're going down. Dow theory says we're going down. I'm confident we're going down, and I'm going to be heavy short side of the market.
Mm-hmm.
When we have a circumstance right now when the Dow theory is still negative, but the VIX has also declined, those are competing signals. This is when I see the brightest yellow flashing light. This is when my caution, when my defense is most on the field. And I adjust my portfolio to be able to, there are times when you're looking to make a killing, and there are times when you're looking to limit damage.
Wealth preservation.
Absolutely. And right now, to me, I'll tell you exactly where I am. I too am a devotee of Dow theory as well as the VIX, because, again, two completely different ways of assessing volatility. When they agree, they agree. When they disagree, they disagree. When they disagree is when I feel the most uncomfortable. I am going to weight more heavily right now on the Dow theory. And while I am not all in on negative, I am definitely heavier weighted negative. So I think I see exactly what you see.
Yeah, I think we're kind of looking through when we often look at a lot of things through a similar lens. So you're looking more wealth preservation, and that's interesting because, you know, a couple weeks ago when we talked, the Dow theory turned bearish, and then the VIX was indicating all kinds of volatility. Pretty clear then, and we saw that big move to the downside. Now the market has popped up, and yeah, there's a lot of uncertainty. It's really tough to read the market. And then we've talked about, like, crypto under the surface has had quite a run as of late too. I was just looking at some of the names, and then we've talked about the meme stocks. So what I'm going to throw one. You know, I love to give at least one little pick, and I'll ask you for something that you like, because you always give us really interesting stuff too. If one of the plays that I'm doing right now, and it's still kind of risky a little bit, but I really love this stock, and I think I've talked about it before. It's a business development company. It's a business development company that pays a monthly dividend, and it just recently had some decent earnings, and that dividend looks really sustainable. And so I always like throwing one out there. One place that I often will park gains, and I've built it a little something through this as well, is the ticker is PSEC, Prospect Capital Corp. It's trading right now at about $8.15 a share. It throws off a monthly dividend of about 6 cents. I love that quick turn, and that's one of my tactics I've been doing, is buying that on the dip, parking cash in there, maybe getting that quick dividend. So I just wanted to throw that out there. And then in full disclosure, I've been shorting the market here and there, picking my spots. Sometimes I win, sometimes I lose. Yesterday was a really, really good day for me. I did have a short on today and took it to the shorts a little bit. But those are just two things I'm playing with. I've also been dabbling and buying the dips in currency, always looking for extreme value. But this is just play bucket money. And, I've taken some, when I'd moved into the oil sector as well, and I've taken some profits on some conservative value items that have done well, and I'm using them for some dry powder. But, just kind of lightly playing more for fun right now. What are you doing? And maybe give me a name or two.
All right. If you want to prove that Beelzebub is opening a new ice rink, you just talked about a solid dividend stock where you're parking cash, right?
Right.
That's what you would usually expect to hear from me.
Right. Oh, totally.
My answer is completely opposite yours.
Wow, that's refreshing.
It is. Like, this is, fun. But what I've been doing lately is there are these crypto coin mining companies, and they have been beaten down silly, and two names, Hive, and that's the symbol HIVE, and Bitfarms, BITF. These things have both been beaten below 4 and below, maybe I think it's Hive is the one that's actually been driven below 2. So I have been going long these because they are very, very cheap.
You see the extreme value, huh, on these?
I have been shorting covered strangles against them. Now, what that means in short, and the name sounds cool, but it's very simple. I've been shorting a covered call above the current price, and then I've been shorting a put below the current price. And in the last several months, I have actually been able to drive my true adjusted cost basis,
right,
below zero because these things are so cheap. So I now own them 100% risk-free because I've already pulled all the money out that I put in to begin with.
Right.
But you want to talk about a segment of the crypto world that if the crypto world survives, this area, this crypto mining area, I think is ripe to be the next segment of huge consolidation and roll-up where you start out, we have the Riots, we have the Bit Farms, we have the Hives, and several other companies like that. Eventually, big fish are going to start getting bigger by eating smaller fish. And that's really somewhere I want to be.
Yeah, I think that's going to happen in the cannabis space as well. But I'm there with you. These crypto mining stocks are very interesting. I'm glad you've made a move on them. One other in the space that I like, and it's very full disclosure, dollar cost averaging into this as well, is Coinbase, ticker COIN. That's also kind of in that space. So, but I like that. So you like the. So how long have you been in these? Do you play the bottom and it's it sounds like you've made a pretty nice move on this.
Yeah, and it's been a few months now, and it's funny you mentioned Coinbase. I've been in and out, I have been round tripping Coinbase for a little over a year, and I have been in and out of Coinbase successfully, mind you. I have been in and out of Coinbase so often. Management called and told me to quit it. They were getting dizzy.
You gotta love that, right?
Yeah, I love Coinbase.
Yeah.
Absolutely love it. And for the record, much like we're talking about the various buckets in the portfolio,
right.
I have Coinbase. I have some Coinbase in the part of the portfolio that I will simply never sell. My kids can decide whether or not they ever sell it. There's another segment that is in and out over the course of days and weeks. I also do Coinbase within a trading day. So there are 10 million different ways to play Coinbase, and I haven't found a bad one yet.
Well, and there you go. I mean, long-term prospects, really good. Buying it at a cheap price now. You could hold those forever. But like you said, the volatility's there to really make moves on a day-to-day basis. I know you have a family investment club meeting coming up, so I promise I wouldn't keep it too long. As we're wrapping up today's Gains episodes, because I know your wife is preparing to she's speaking tonight at the Family Investment Club, so we don't want to keep her waiting. Any final shots, Matt? We've talked about volatility, gave a couple names, talked about how things have changed over the world. Final shots on today's conversation.
Well, if I had to pick a headline for our conversation today, it's to encourage people to start to become more and more aware of the metrics available to assess volatility in order to improve your odds of being right, in order to improve your odds of making the right call. Are you long? Are you short? Are you neutral? And always using these things because they're very, very powerful tools. Always keep your fingers on that volume control so that you are reacting appropriately, whether the market's going up, down, sideways, or if it's like right now where you just don't know. If we just don't know, nobody knows, nobody's confident. I say that, and I agree with you, I think under these circumstances, you have to be shading the downside very little risk if you're wrong, but really big rewards if you're right.
All right. We'll leave it there. Bring you on again real soon, Matt. I love our conversations. That's Matt Matigian, CEO of Blue World Asset Managers here in Chicago. And as always, check out Matt's blog, blueworldam.com. Real quick, Matt, give that email. You always make yourself available for our audience.
Sure. On LinkedIn, Dr. Matthew Matigian, Matigian, and M. Matigian, MMATIGIAN at blueworldam.com.
All right, so thanks for sharing that with our audience. Hey, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts. If that's an option for you, totally be doing us a solid, by the way. And subscribe and turn on those notifications so you know when a new episode drops. Our next games episode will drop on Wednesday morning, so we will see you then.
A News Radio WBBM podcast powered by Odyssey.